between MFT and First Mortgage. Today's topic is going to be on the subject of how much can I borrow. So hopefully you can all see the slides in front of you. Our contact details will be included on every single slide. So you'll see an email address to hellobath@firstmortgage.co.uk and our generic telephone number 01225 970 830. That's 01225 970 830. So essentially, we've got a partnership here at First Mortgage with Manchester Foundation Trust, along with a number of other NHS trusts as well. And we basically provide mortgage education and free mortgage advice to all NHS staff as part of our partnership with MFT. So that includes webinars on a monthly basis along a range of subjects and titles, all related to mortgages and how much you can borrow as NHS staff. So I'm going to go through today's slide. It should take about 25 minutes to get through the slide deck. There will be an opportunity for a Q&A at the end of the webinar too. And equally, if you do want to book in a free one-to-one consultation at any point with any of our mortgage experts, you can do that just by following the details on each slide, either the email address or the telephone number there. Feel free to email the team and book in a free one-to-one appointment over the phone or on a Teams or Zoom call, whatever your preference is. We're also up in Manchester at various sites in April and in May as well for on-site visits, myself and another staff member. If you want to book in a free one-to-one consultation face-to-face when we're up in April and May as well. So today's topic is on how much can I borrow. In terms of the agenda, so I'll give you a very quick overview of those of you who haven't attended any of these educational financial wellbeing webinars previously, on who First Mortgage are and what our services offer. We'll also then understand the current mortgage market, explore challenges that NHS staff face, as well as sort of try and demyth any theories that NHS staff can't sort of take out mortgages. We'll look at specific schemes available for NHS staff and additional enhancements to lending criteria, which allows you to borrow a bit more money working for the NHS. And at the end of the webinar, there'll be, as I said, an opportunity for a quick Q&A following a quick review of the market and a prediction of where mortgage rates as well as interest rates are heading for the rest of 2026. So first of all, who are First Mortgage? So First Mortgage, we are a large business which all originated in Scotland, but we're based all over England and Wales as well. So basically we're one of the largest mortgage brokerages in the UK. And we're a whole of market broker, which I'll go on to explain very shortly. We provide the mortgage service for the likes of Amazon in the private sector, as well as Specsavers and a few other sort of larger organisations. In the public sector, we provide the mortgage service for over 750,000 NHS staff, which includes the likes of Manchester Foundation Trust, United Hospitals Birmingham, North West Ambulance Service, London Ambulance Service, as well as a host of other large NHS trusts all over the UK. All our advisors are very experienced in dealing with NHS staff. We've seen it all before. They've all got 10 years experience in dealing with NHS employees' mortgages. So whether it's basic salary, unsociable hours, any banding you've got for different levels of occupation, we can use that income towards affordability to basically get the best mortgage outcome for you. So we're a fee-free broker, which means you don't pay a fee at all for any of the advice you receive from us. We deal with the whole application from the start to the finish, which also involves getting you financially qualified at the start and giving you an idea of how much you can borrow, which of course is the title of the webinar today. And we also offer a free protection review as part of our process to ensure that not only can you get the mortgage, but you can maintain that mortgage and stay in your home for the next 25, 30, 35 years, whatever it is. You want to make sure that that mortgage is affordable now, but also in the future, regardless of whatever life throws at you. We're open anytime throughout the week, so 9 AM through till 7 PM, Monday through to Friday. Also open on weekends as well on Saturday, so you can book a free appointment with one of our specialist advisors to discuss your options and any sort of unique challenges you think you might face as an NHS staff member to work out how much you can borrow based on your own circumstances. So as I mentioned, we're a whole of market mortgage broker. That essentially means we're not tied to a small panel of lenders. So most mortgage brokerages have got access to around 6 or 7 lenders they can choose from. Because we're a whole of market broker, we get access to over 90 lenders, and that means anywhere between 12 and 15,000 rates available on a daily basis for you. As I said, our advisors are very experienced. We've got, between all of our advisors here, we've won numerous awards at the sort of most coveted awards in our industry, which is the British Mortgage Awards, which includes the best overall advisor in the UK, the best new build advisor in the UK for any new build properties, and also the best first time buyer advisor in the UK. That's out of obviously thousands and thousands of mortgage brokers out there. So very quickly, before we look at how much you can borrow, it's probably more prudent to identify the house buying process, because the majority of people watching this webinar either now or sort of when it's recorded will probably be first time buyers. So before you think about essentially buying a property, you need to of course know how much you can borrow, which of course again is the subject of this or the title of this webinar. And to do that, you need to get financially qualified. To get financially qualified, you need to book an appointment with a specialist mortgage broker, such as a broker at First Mortgage, who can guide you through the process to work out how much you can borrow very quickly. So that process takes typically between 20 and 30 minutes. They'll ask you a series of questions, which will involve the basic details, first of all, things like your personal information. So what's your name on your passport? Obviously your legal name, your date of birth, your address history, the last 3 years, to identify where you've lived. They'll identify how much you earn based on your salary, what your income is, if it's a permanent job, when you start in that job role. They'll also look at any details such as any financial commitments, so any personal loans, any hire purchase agreements you've got on a car finance, for example, any credit card debts, any student loans, any childcare costs you pay, just to make sure we've got obviously everything written down in terms of any commitments you've got financially. What your advisor will then do is work out very quickly, using a host of digital tools we've got, the maximum you can possibly borrow out of all of those 90 lenders. On that basis, we can then come back to you at the end of that call, whether it's a Zoom call, a Teams call, or even on the phone, and say, good news, you can borrow X amount based on your circumstances because your salary is X, your commitments or outgoings are Y, which means you can borrow a maximum amount, for example, of £250,000 or £400,000, whatever it is, based on your individual circumstances. At that point, your advisor can provide you with what's called a DIP, which is a decision in principle. You might have heard it called a mortgage in principle or an agreement in principle. It's exactly the same thing. It's just different mortgage jargon, different mortgage brokers use. A decision in principle is basically a certificate which confirms how much you can borrow based on your circumstances, subject to proof of income and subject to credit scoring. But you can use that to provide towards any estate agent or any new build developer, and it shows to them you've spoken to a broker and you know you can borrow the full amount you need to borrow in order to buy a property based on how much you want to buy for. So in terms of NHS workers, there is obviously a myth that you can't borrow as much as other people based on your job role and because of the remuneration or way in which you're paid. So in terms of how to give you sort of a bit of context in terms of the wider market and how lenders often view NHS employees, given the high social value roles that NHS staff obviously play, given how stable the income is and the fact that obviously it's a public sector, you're actually probably a very safe bet for all mortgage lenders. Reason being is that there's very, very seldom any redundancies, certainly within clinical staff within the NHS, sometimes of course admin, but versus private sector job roles, it's a very secure industry to be in. There's also very strong demand for NHS people, NHS workers, to buy property. And because of that, lenders do often favour NHS employees a bit more highly than they would do people even in the private sector. And that goes to show for things I'll discuss a bit later on, for things like own social hours, any overtime, because it's generally consistent. Lenders will like to use that, and they're really good for sort of applying 100% of that additional income towards affordability, which allows you to borrow a bit more money, versus, for example, using commission or bonus or any other forms of income that people working in the private sector sometimes receive, certainly in sales roles. So in terms of the mortgage myth or reality versus NHS mortgage discounts, so strictly speaking, as it stands right now, there are no specific NHS discount schemes available. Having said that, NHS employees do qualify for a number of different schemes available through the mortgage market, which basically cater for NHS staff. So, as I mentioned earlier, for NHS staff, lenders look to use enhanced affordability to allow you to borrow more money based on your job role and occupation. They'll look at more flexible lending criteria to use your overtime and a shift allowance towards affordability calculations to let you borrow more money. There's also lower deposit schemes available too. I'll go on to speak about this in a few minutes, but there are 2 or 3 schemes available to NHS staff, which you can buy a property with 0% deposit available. So if you've got no money to put down for a deposit, but you've got a little bit of money to pay for example, £1,500 or £2,000 for solicitor's costs, it might be we can get you a mortgage for 100% of the property value. There's also certain lenders which apply a number of different schemes to new build properties, which we're going to discuss in a few minutes' time. But essentially, to answer the question as regards NHS mortgage schemes, there aren't currently in existence any specific government-funded NHS mortgage schemes, but there are a handful, a large handful, I should say, of mortgage schemes available, albeit on low deposit mortgage schemes or enhanced multiple incomes, enhanced affordability, which allow you to borrow more money or obviously get a better rate based on a lower deposit because of the sector in which you work. So looking at those government schemes very quickly that NHS staff can take advantage of. The first one is what's called a shared ownership mortgage. You may have heard of this. Essentially, it's a shared ownership scheme is a government incentive which allows you to buy a small percentage of the property if you can't afford to buy the whole property. Typically, that's anywhere between 10% up to 75% of the value. Most people usually start at 40 or 50% of the property value. So what you then do is you'll get a mortgage for 50% of the property value. So say, for example, you see a property in Manchester for £200,000. You can't afford to buy that for £200,000, but you can afford to buy 50% of it. You then buy 50% of the property value, which is £100,000. You then put down a deposit against that £100,000, 50% amount you're basically going to buy. What you'll then do is pay rent on the remaining portion, which is retained and owned still by the housing association. That essentially means that there's a much lower deposit needed because you're only buying 50% of the property value, which is very popular in sort of high demand areas near hospitals where there's sort of large infrastructure and a lot of people are working in the area. And it helps NHS staff get on the ladder a bit more quickly if they can't afford to buy the whole property right now. It means you can what's called staircase in the future when your income increases, when you've got more money or disposable income, allows you to buy the property in small chunks. So, for example, you start and you buy at 50% of the property value. It might be you remortgage 2 years later on. You then buy 60% of the property, and then 2 years later you buy a further 10% up to 70%, and so on until you staircase all the way to 100%, at which point you own the full property outright. The next scheme available is what's called the First Home Scheme, which certainly is very important for NHS staff. The reason being is we see a lot of NHS staff go for this scheme. It's only available on new homes, and it must be advertised under the New Home Scheme. Essentially, what it allows you to do as a public sector staff member for the NHS is buy a property at anywhere between 30 to 50% discount off the normal purchase price. The caveat being that when you come to sell the property in the future, whoever you sell that to must also be eligible for a first home, and you must also sell it for the same discount that you received initially. So if you buy a property with a 30% discount, even if it's increased in value and doubled in, say, 20 years' time, you've then got to sell it for a 30% discount at that point to somebody who's eligible for a first home scheme, which again will be a first-time buyer who must live in the property. And also there are local salary caps which apply. So if you earn too much money, typically over £70,000 per annum, you may not be eligible for this. But it's a really good government scheme to take advantage of, which we've done hundreds of NHS mortgages for. So it's called the New Home Scheme. That's available on specific first homes or obviously new build properties in the local area. Other schemes available for government schemes which NHS staff can take advantage of is the LISA, which is called the Lifetime ISA, or LISA for short. Essentially, the government gives you a 25% incremental bonus on savings you make in any year. So that's up to a maximum of up to £4,000 a year you can save. The government then will give you 25% bonus for an extra £1,000. So for every £4,000 you save a year, the government will give you an extra £1,000 top up towards your new property purchase. So what you can do is you can combine that LISA, the Lifetime ISA, which allows you to save money more quickly through the government scheme, with a shared ownership property, which can be a quicker route to market when you come to buy a property, because you need a small deposit and the government help you to get that deposit more quickly by adding £1,000 bonus onto the £4,000 you save in a Lifetime ISA as well. There's also something called the Right to Buy scheme or the Right to Acquire scheme. So this is only available really for people who have lived in a property for a long period of time in a council property. If you lived in a certain property, council-owned property for X amount of years, depending on where the area is, it'd be worthwhile checking with your local authority. Sometimes you get offered a discount to buy the property under what's called Right to Buy. So it might be that you get outside of London up to £80,000 discount off the purchase price because you've lived the property for 5, 6 or 7 years, which allows you to take out any standard mortgage. But it means basically If the property, as an example, is worth £200,000, you've got no deposit to put down, but you've lived there for, say, 6 or 7 years in a council-owned property, they might be willing to sell it to you for, say, £130,000, which is £70,000 discount. So that discounted price of £70,000, so that discounted value, would act towards your deposit. So effectively, you then borrow £130,000 on a property worth £200,000. So as long as you can borrow £130,000 on affordability, that allows you to buy a property that you've lived in for 6 or 7 years if it's a right to buy property. You'll probably be aware if it is, well, certainly be aware if you're living in a council-owned property. If you've not heard of the right to buy scheme, always worth inquiring with the local authority to see if you're eligible for that scheme based on where you live. Other minimum deposit schemes available. So again, these aren't specifically NHS deposit schemes, but they are available for NHS staff members. So there is a relatively recent addition to the mortgage market. It's called the zero deposit mortgage, or the track record mortgage is a separate name for it. That is available through one of the biggest building societies in the UK, Skipton Building Society. Effectively, this scheme allows you to buy a property up to 100% loan to value. So that means if you've, again, use that same example, if you see a property like for £200,000, you have got very little in the way of deposit to put down, you might be able to borrow £200,000 to borrow 100% of the value of the property. So this scheme is only available for those who have rented for a minimum period of 12 months within the last 18 months. Even if you've just moved back in with parents or moved into separate rented elsewhere, as long as you've rented for a minimum period of 12 months in the last 18 months, as long as your credit score is okay when you come to apply, you can basically apply to borrow 100% of the property value. Again, that is subject to certain caveats. So first one being that the mortgage payment that you make every month on the mortgage must be equal to or up to a maximum of 120% of the last 6 months rental costs. So to give you a pure example there, if the rent has been paying is £800 a month previously for the last 6 months, the maximum the mortgage payment could be for a new mortgage would be up to £960, which is 120% of £800. So if you've been paying quite high rent at the moment, chances are that a mortgage for a property, again using that example of £200,000, would be similar or even lower than the rental payment. So the mortgage payments on a property worth £200,000, even if borrowing £200,000 for a new mortgage, chances are those mortgage payments will be lower than what you're paying in rent. So if you are renting at the moment, you've got little way of deposit, book in, speak to one of our advisors, and we can discuss those minimum deposit schemes for you. Because it might be if you've got a history of renting and you've got decent credit score, that you can borrow enough money to buy the property even with no deposit. That is available over a 35-year maximum term, depending on your age at the time you apply. And it's available up to a LTI, which is a loan to income of 4.49 times your income. So as an example, if there's two applicants who are both earning £30,000 each, you've got £60,000 joint household income. That means you can borrow a maximum of 4.49 times income, which is £269,400. Sorry, £269,400 on affordability based on a joint household income of £60,000. If your income is over £100,000 jointly between you as a household, you can borrow up to 4.75 times loan to income, which means you can borrow £475,000 in theory. If your income's £100,000 as a household. So yeah, just to reiterate the point, summarise that. If you are struggling to form a deposit, but you've got decent income between you and you have been renting in the last 18 months for a minimum period of 12 months, book in, speak to the team, because we can look at the zero deposit needed mortgage or the track record mortgage. With Skipton, we've done hundreds of these mortgages for NHS staff members to get you in the property, get you on the property ladder, sorry. It is available up to property values of £600,000 maximum. And again, it is subject to standard policy conditions. So you must be able to basically meet the credit score on there. If you've got any missed payments, defaults or counter court judgments against you, it might be that you're not eligible for that. But if you've got a half decent credit score, chances are you will pass a credit check with Skipton on that zero deposit mortgage. There's also a further minimum deposit scheme available. The no deposit mortgage is available through a mortgage lender called April Mortgages, who's a very big lender, again, in the intermediary market or the broker market in which we deal. That is available for any applicants who are first-time buyers, again, up to a maximum LTI. So LTI, again, stands for loan to income of 4.49 times income. Unlike the previous scheme I mentioned, which is the track record mortgage, where you have to have a track record of renting, there's no requirement for that with April Mortgages. The only minimum criteria with April Mortgages is that you must earn a minimum of £24,000 household income, either full-time or on a part-time basis, or if you're self-employed, you must have an average net profit of £24,000 minimum over the previous 2 years. Currently, that property that is only available on houses, not available on flats. The minimum property value of £75,000. It must have a clean credit history once again, and that is available on a 10 or 15-year fixed rate. It's a specialist product available, which a lot of NHS staff have taken advantage of, whereby they earn over £24,000 a year, which allows you to borrow 100% of the property value. So if you are struggling to buy a property and you've got no deposit to put down, speak to the team, see what you're eligible for. Again, using that same example, if you've got household income of £60,000, you can borrow 4.49 times income, which again, in theory, is a mortgage of 269,400. So even if you've been living with family or parents or elsewhere, haven't been renting, that scheme is the one for you, and our advisor can advise you as regards your eligibility for it and get a mortgage for you on a property without any deposit required. The last one we look at is what's called a rent-a-room scheme. So this is very popular for NHS staff who generally are buying on their own, whereby they want to buy a property, but they might struggle with the mortgage payments. And what you can then do is rent out a room. So you can use that future lodger income towards affordability, even if you haven't received it yet, because of course you don't own the property. So this would require a kind family member of yours to apply a 20% charge, the mortgage lender to apply a 20% charge against their property. So as long as they've got sufficient equity in their property, so if they own a property outright, or if they've got a low mortgage on a high value property and they're willing to help you out, the mortgage lender can apply a 20% charge against the parent's property or brother or sister's property, whoever it is in your immediate family. And that allows you to borrow 100% of the mortgage value against the property you want to buy, as well as using lodger income or future lodger income towards affordability to maximise how much you can borrow to basically get there. So again, this is a really helpful scheme for those people who especially are buying on their own, who are due to rent out one of the rooms to get some lodger income, and if they've got a family member that can basically apply a 20% discount, sorry, not discount, 20% charge, sorry, against their property. It might be a bit more of a complex one to explain on a webinar, but by all means do reach out, speak to one of our experts, and we can explain that in more depth for you to see if you're eligible for that scheme as well. So switching back to challenges faced by NHS staff in the mortgage market. As I mentioned, NHS staff often have complex income structures, which I says includes irregular income, shift allowances, overtime, even locum work as well. Traditional mortgage lenders in the past have been sceptical about using that, but really we've seen the last 5 to 10 years a big shift from mortgage lenders who really view public sector workers as sort of a safe bet when they come to lend their money to. This is why First Mortgage have stepped in to help thousands of people in the NHS, not just Manchester Foundation Trust, but all other trusts and employee members to basically buy a property, as well as help them to remortgage in the future when obviously their deals come to an end. So our specialist knowledge from our advisors will help you basically navigate the mortgage market. But it's always worthwhile booking in a bespoke individual consultation with yourself and a partner, yourself and a friend, or if you're buying on your own, just in your own name, just to work out your circumstances, see how much deposit you need to put down, see how much you can borrow based on your income, and you can basically put together a credible plan of action to get yourself on the property ladder. In terms of other unique challenges that NHS staff face, so you've got things like NHS pension contributions. Some lenders deduct pension contributions. They treat them as if you're paying a monthly loan, which is really unfair because obviously you get a taxable benefit there with pension deductions. So using our knowledge in the industry, we know straight away lenders that basically ignore pension deductions and treat them as being discretionary, and basically have the stance that if, for example, you couldn't afford the mortgage in the future because you're putting £500 a month towards your pension through your employer, they know that in theory you'd cancel that to be able to afford the roof over your head and continue paying the mortgage. People on 0 hours contracts, not so regular as it was probably even 5-6 years ago, but there are a lot of 0 hours contracts employees with the NHS. Again, there's a myth that you can't get a mortgage with the 0 hours contract. I've done plenty myself, as long as you've got 12 months history of working on a 0 hours contract basis, or if you're on a short fixed term contract, as long as you've got 12 months history, I'd be very, very confident to get a mortgage for you, even if you're not in a permanent job role with the NHS. But again, if you've got any questions about your general situation as regards any complex income you've got, or if you are trying to navigate the mortgage market yourself, do feel free to reach out and book an appointment with the team by emailing hellobath@firstmortgage.co.uk, or give us a call on the number on the screen, 01225 970 830. Okay, moving forwards with the webinar into how much you can actually borrow. as an NHS employee. So you've heard me talk about this, the abbreviation LTI, which stands for loan to income, which basically is the loan you can borrow versus the income you have. So generally speaking, that is in the industry at the moment, it's 4 to 4.5 times income is the average you can borrow based on your salary. It's not, however, quite as easy as that. Okay, the reason being is that lenders also look at financial commitments such as personal loans, car finance, any childcare costs, any other substantial outgoings you might have, and that will affect affordability. So it might be that, yes, you've got £100,000 salary, and yes, you can borrow up to 4.5 times income, which is £450,000. But if you're paying £2,000 a month in childcare costs or nursery costs, that's going to offset how much you can borrow, which is why it's worthwhile speaking to an expert at First Mortgage to work out exactly what you can borrow based on your individual circumstances. So I said the average income multiple is 4 to 4.5 times income in the UK market at the moment. We work with a building society, which is Principality Building Society. A lot of you may have heard of the Principality Stadium, which is the biggest national stadium in Wales. It's the only national stadium, but it's the biggest, one of the biggest stadiums in the UK. Principality Building Society are their sponsor, and they are a really large building society in the mortgage market. They lend across the whole of England and Wales. And just because you're an NHS staff member, they will lend you 5 times income straight away. So regardless of whether you're a doctor, a nurse, a consultant in any clinical job role, even if you're an administrator or a cleaner, you don't have to be a medical professional, as long as you've got an NHS payslip, we can get your mortgage up to 5 times income. And again, that's not just the one person that works at the NHS. If you work at the NHS, your partner doesn't, that 5 times income applies jointly to both of you as a household. There's also enhanced affordability for NHS clinicians, the likes of nurses, paramedics, ambulance drivers, midwives, the list goes on. If you're an NHS clinician, we work with a lender who can lend up to 5.5 times income just because of your job role you're in. Again, you just need a payslip to confirm what your occupation is. As long as that's a legit NHS payslip, we can get you 5.5 times income. So again, that's more so than industry average, which is 4.5 times income, which will allow you to get on the property ladder a bit more quickly and borrow more money. That's available both on a first-time buyer basis, a next-time buyer, and even for a remortgage if you're trying to remortgage as well. Switching back to the minimum deposit scheme. So we mentioned the deposit schemes which have got 0% deposit. If you've got a small deposit, even of £5,000, you might be eligible for the £5,000 deposit mortgage scheme. That is available through Accord Mortgages, who are part of the Yorkshire Building Society. And the £5,000 deposit mortgage is available to first-time buyers only, and effectively it acts up to a 1% deposit or a 99% loan-to-value scheme. The reason being is the maximum purchase price of any property is £500,000. So effectively put down £5,000 deposit, it's going to be 1% of that value. Regardless of whether you buy for £500,000 or £200,000, you still need a minimum £5,000 deposit to put down against the purchase price. The reason I'm highlighting this scheme is that the rates will be better than the schemes available with no deposit, because you're putting down some of your own money. Also, the credit scoring criteria is a bit, I guess it's a bit less arbitrary, and it's easier to pass a credit score with a £5,000 deposit you're putting in of your own money. Again, that's available for a maximum term of 40 years. It's available on both houses and flats. It's not available on new build flats, only on older style properties which have been built for at least 2 years. Available on a repayment mortgage, and it's available to 4.49 times joint income or single income, depending if you're a single household applying or in joint names. Now, the most interesting scheme available, which is what we've probably done the most work with, which is really good for affordability, and again, really sort of tackles the subject line about how much you can borrow, is what's called the Helping Hand mortgage. So I've harped on about the loan to incomes being 4.49 times income. Generally speaking, as a single household member or a joint household member, 4.49 times income. The Helping Hand mortgage scheme allows you as a first-time buyer to borrow up to 6 times joint income. And again, as long as regardless of whether you're an NHS employee or not, going back to my point I made earlier, there aren't any specific NHS mortgage schemes available, but we've applied this scheme to literally thousands of NHS staff over the last 3 years since this scheme's been up and running. The Helping Hand scheme allows you to borrow up to 6 times income, regardless of whether you work for the NHS or not. So this is available through Nationwide Building Society, and effectively it means, as a household, if your minimum income is £30,000 as a single applicant. So if you earn £30,000, rather than borrowing up to 4.49 times income, which is 134,700, you can borrow up to £180,000 if your salary is £30,000 and you're a single applicant. Equally, if you're in a joint application, you must earn a minimum between your £50,000. So again, the differential being with most lenders, you can borrow 4.49 times income. So if your joint salary is £50,000, you could borrow 224,500. Whereas with this scheme at 6 times income, you can borrow up to £300,000. So Nationwide Building Society launched this scheme. It's been really, really popular for first-time buyers. It's available on a 5 or a 10-year fixed rate only. Okay, the only caveat being you must pass a credit check, but also you must put down a minimum of 5% deposit of the property purchase price. So again, we use that same example. If you're buying for £200,000, you would need a £10,000 deposit to put down, either from your own savings or a gift from family, basically to be eligible for that scheme, as long as you pass a credit check and you earn £30,000 as a sole applicant or £50,000 minimum as joint applications. I can get you a mortgage, or we can get you a mortgage, sorry, of up to 6 times your salary. That's not the only lender that can do 6 times income. So if you are a newly qualified doctor, straight away, just by virtue of the fact your job role is a newly qualified doctor, you can borrow up to 6 times joint income with the cooperative bank. No minimum time in employment, and as long as the new job role starts within 3 months, you can actually apply for 6 times income before you actually start that new job role. In terms of other schemes available, so there are a number of other schemes available for NHS staff members. They aren't specifically NHS related, but they're related to NHS staff by virtue of the fact you're qualified for them. You just need to speak to one of our mortgage experts who will understand your circumstances, goes through the mortgage fact find, which essentially is a 30-minute questionnaire with you, really, and then they can identify the best schemes available for your circumstances and identify how much you can borrow as a maximum, as well as giving you an idea of what the mortgage payment is going to be and on what rate you're eligible for, so that you know you're fully prepared when you come to buy a property, that you can borrow the maximum amount you need to borrow and how much it's going to cost, and it's going to be affordable to your monthly budget as well. Very quickly, touching on financial protection, I mentioned at the start of the webinar, our job as mortgage advisors is to ensure that A, you can borrow as much money as you want to, and B, buy the property you want to borrow. Buy the property you want to buy. C, we want to make sure that you stay in that property and you can afford that mortgage now and in the future. This is why financial protection is really, really important. We've got a strong emphasis on making sure that you maintain the same lifestyle and can pay the bills on an ongoing basis, not just now, but in the next 20, 30, 35 years, whatever it is. So when you speak to one of our experts, we can also book you in with a free one-to-one consultation to discuss your needs financially in terms of financial resilience, to make sure that you are financially resilient against all of life's curveballs. We want to make sure you've got any additional life insurance, any critical illness cover, any income protection in place, so that you are financially secure. So should the worst happen, you haven't got to sell your property that you've worked so hard to get because you can't afford it anymore. You've got financial protection in place which allows you to clear the mortgage debt should the worst happen. So as part of our process, when you speak to one of our mortgage advisors, we'll also look at financial protection options for you as well. Okay, coming towards the end of the webinar this afternoon, so we'll look very quick look at the mortgage market itself. So where are we right now? So currently, the Bank of England base rate is at 3.75%. Sounds quite high still, but given where we were back after the disaster of the mini budget in 2022, in the infamous Liz Truss era, when mortgage rates peaked, the Bank of England base rate peaked at 5.25%. We're now 1.5% below that at 3.75%. The Bank of England base rate, the latest Monetary Policy Committee meeting was held a couple of weeks ago on the 5th of February. There was quite a tight vote, 5-4, where the Monetary Policy Committee members decided basically to hold the base rate at 3.75%. That was more or less in relation to the CPI, the Consumer Price Index, inflationary rates being a bit higher than they wished to at 3.4%, which rose from 3.2% in December. So the general consensus in the industry, economists predict, and all sort of the banks that we speak to on a daily basis predict that there are going to be 2 to 3 Bank of England base rate cuts in 2026. So there is cautious optimism that the base rate is going to come down to 3% to 3.25% by the end of the year. The main guider, or I guess the main guiding factor towards a base rate reduction is inflation. Inflation has been really, really sticky over the last probably 2 to 3 years now. The government target is 2%. We're currently at 3.4%, which rose in January based on the December numbers. Inflation numbers are due out very shortly for the next month, and assuming that the inflation numbers go down to somewhere closer to 2.9%, but certainly down south towards 3%, we should see some further base rate reductions. So the predictions are that we should receive a base rate reduction at the next meeting. If that's not going to be in March, they're looking at April, and they're then predicting a further base rate reduction in July and possibly October. So we're not nailed in to have 2 base rate reductions, but it's very, very likely. I guess the forward-thinking trajectory of where inflation is going to head later in 2026 is that we should see a minimum 2 base rate cuts down to 3.25%, or 3 down to 3% overall. How does that translate to mortgage rates? So mortgage rates right now for 2 and 5 year fixed rates are well below 4%. Certainly if you put down a 25% deposit or more. If you're putting down a 5% or 10% deposit, you are going to be looking at a mortgage rate over 4% still. But by the end of 2026, we should see, even with a 5% or a 10% deposit, mortgage rates starting with a 3 and being below that 4% barrier. Obviously, the caveat being is that is subject to inflationary pressures and any global events in terms of, for example, the Ukraine war escalating, or any sort of other conflicts which may happen. Fingers crossed doesn't, but if it does, and that affects, for example, oil prices in the UK, which affects the UK economy, which affects how quickly inflation declines, that will obviously have an impact on how quickly the base rate comes down, and that therefore impacts how quickly mortgage rates tumble as well. But all being well, fingers crossed, we should see a minimum, I predict, of 2 base rate cuts this year, with mortgage rates following, and there being a bit of a domino effect in the market, and mortgage rates being a lot lower by the end of 2026 as a result. So I'm going to stop that recording now and give you the opportunity to ask any questions in the chat. And again, this will all be available again and uploaded by the financial wellbeing team at MFT a bit later on. So that is all. Stop recording now.